I'm Matt Stout, and as the STR Loan Guy, I'm constantly helping people buy real estate. Whether it's an investment property or your first time home, we have a lot of options, and I wanted to show you a few. So, at the end of the day, there's different ways to do real estate deals. You can buy a house to live in with little down, you can buy a house as a second home for a vacation rental, but it's going to have a lot of limitations, or you can buy it strictly as an investment property. So, when I find something interesting, because I'm also an investor that I can't buy but I want to share, I like to make a video to show you some examples. And here's a great one that I found in Harpers Ferry, West Virginia. Now, it's a really awesome property. It's got a lot of potential to make a great Airbnb. And what I love about it is that it's right next to a club that has a private lake that you can be a member in, and it's only 20 minutes from downtown Harpers Ferry. Now, Harpers Ferry is a historical site. They get over 500,000 visitors a year. Plus, it's right along the Appalachian Trail, so you get a lot of people that want to come for the weekend hike. It's also only a short drive from Washington, D.C., so it has a pretty big draw as a vacation area. And people come all over just to see the area. It's close to Shenandoah National Park. It's a really cool place. So at the end of the day, what would this thing look like if I wanted to buy it as a second home with only 10% down versus an investment property? Now, we all know if you wanted to buy it as your house, you're going to have better options. But if that isn't what you're into and you just want to do this strictly for an investment, here's some ways we would approve this loan. Now, my friends at STR Insights, they have this awesome website that tracks every Airbnb out there, and it tells us what kind of income it would make. It says, here's an average of what they'll do, and it also lets me pull comparables. Well, this one, you can see they're saying the average is around 55,000, but there's properties around there that are doing over 100,000. Now, granted, this one right here, I can go straight to the site and look at it. It's right on a lake. It's not quite as comparable. Ours is, this one I'm showing you is just down the street, and there is a way you could get a membership to use the lake. But as far as being as nice as this one, no, I would say not. But there is an average one, very similar, which is the partial lake view that might be similar. You'd have to dig into the weeds a little bit, but we're able to use close to $70,000 in revenue for this property based on how we would underwrite it. So how does that look? Now, if you wanted to buy this as a second home, you could do it with just 10% down. So what's the difference between a second home and an investment property, right? Well, a second home says you're going to use it at least 2 weeks a year, but it doesn't restrict you from renting it out as long as it's going to be a part-time residence. So at the end of the day, you can do this the way, but the difference is with a second home, we are not going to use any income from the property. We're going to base this entirely on your W-2s and tax returns. So that means you got to have a pretty big income. So this one's a pretty affordable property. It's less than 400,000. So it might not be that hard for some people to swing it, but you literally have to, it'd be like walking in and trying to buy a Lamborghini. You're going to have this pretty big payment you're going to have to qualify for with no additional revenue from the property. So what does that loan look like? Well, Fannie Mae will let you do this deal with 10% down. Like I said, no prepayment penalty, which, any mortgage you're used to on a primary residence doesn't have prepayment penalties. That's because any Fannie Mae occupied loan doesn't have a prepayment penalty because it's illegal. So that's probably the biggest benefit, other than, of course, less down. Now, you would have mortgage insurance, and if you were highly qualified, it might only be $50-$60 a month. But if you had a lower FICO, it could easily be 3 times that. So you do need to think about it, and you got to realize that Fannie Mae still charges people higher interest rates for second homes. So what does the rest of this look like? Well, at the end of the day, you're going to get into this deal with less than $51,000. Now, the Fannie Mae will let the seller pay some of these closing costs, and they're pretty high. Fannie Mae's charging you 4 points to do this deal as a second home. So some of that's been absorbed in a higher interest rate, and some of it's being paid up front out of pocket. And there's just no way out of this. It's not as cheap as your regular first-time home buyer loan, but it is a pretty cool option with only 10% down. So what else is there? Well, if I just don't qualify for that, let's just face it, if I wanted to buy this right now, I'd have to qualify using some other method. So how would that look? Well, we do have some loans that'll allow you to do this with as little as 15% down. Now, I'm showing you one with 20% down only because the 15% down product is only for seasoned investors and has some extra requirements. So if we just said you're first at this, you're new at this, it's your first investment property, 20% down it is. And what's the difference with this loan? Well, out of the box, the interest rate isn't a whole lot different. The closing costs, the points were actually lower. than the other option. I think the other one was like 6,000. Yeah, this one's only 4,300, so that's cool. But these types of lenders, they're not Fannie Mae lenders. They have higher fees. I'm just gonna be honest with you. They're not your credit union, your vanilla mortgage company, and they're going to charge you more in what we pretty much just call junk fees. It's normal. That's the kind of loan they are because they're selling these loans to a hedge fund, not Fannie Mae. So they're taking extra risk and they're going to pass that extra cost on to you. Now, what else is different about this loan? Well, let's look at the biggest difference. This loan has a prepayment penalty, so you can't do anything with this deal without paying a 5% penalty. You can get that reduced if you want, but you have to pay more for it and stuff. And you can reduce this down to as little as no prepay, but then it gets real expensive. But here's the huge difference. This loan bases the approval entirely on cash flow, using only estimated cash flow from the subject property. So what does that mean? Well, I showed you back on that previous screen, we had data that we could show that this would probably make close to $70,000 a year. Well, we can use that, and that's it. I don't need W-2s, tax returns. We're going to base this entirely off of the cash flow, which is generally referred to as DSCR. That stands for debt service coverage. It's a commercial term that doesn't apply to Fannie Mae loans because Fannie Mae has to use income to qualify. These loans are looking at just the cash flow from the property. This particular program will use 80% of what we estimated the income from. And at the end of the day, that's $4,800 in income. So what does that mean? Well, we take the estimated income less the 20%. So, because there's going to be some expenses, probably more than that, but we'll use 80% of it. And you divide that by your payment, and you end up with a ratio. This one's 1.712. As long as it's 1.0, I can get this loan approved. Now, there are some different things that you have to know about and how it works at the end of the day, but that's it in a nutshell. So if that's something you're interested in, you want to get pre-approved, you can definitely do that. If you look below my signature, there's a link. Just click on there. You can go right to my calendar. That's the most beneficial way for both of us to meet. Then I can share my screen, figure out what your objectives are, and get you an approval from there. You can also check out my reviews. We live and die by our reviews, and I do everything just like it was me because I'm also an investor and I just want you to win. So I'd love to see you on my calendar sometime. Let's get together and see what we can do to get you into your first or your last deal. Thanks.